Welcome to the War Hunt quarterly market update for the 31st of December 2023. We're recording this in January. It's certainly been an interesting end to the year. If we look at the Australian market, it was basically flat towards the end of October, and then it's been a huge run really for those last 2 months. And that's been across the board also in the US. I think once the US Federal Reserve had sort of signaled that the rate increases had actually ceased and there was the potential for a cut, markets have had a pretty strong run, which the general sense is that there's some normality coming back to the market, Steve. So really in that context, like how has it panned out for Australia?
Yeah, let's have a look at the chart here, Sam. And this is a chart which shows the movement of the stock market daily. And you can see it's a very volatile period last year, although that's typical. But to your point, Sam, by October the 31st, that's right, the return of the market then was zero. So it was looking pretty gloomy. And then when the Feds announced that they were not going to raise rates any further, and in fact the next movement would be down, both equity markets and bond markets all took off, and you can see here that Australia's gained 12% in the last 8 weeks. And in fact, its total return for the year is 12.1%. That's a phenomenal return. It's greater than the average long-term
Yes.
return of the ASX 300. So a really solid year in Australian equities, but really boosted by the last 8 weeks.
Which I think might come as a surprise to most clients and investors. I know when the quarterly report sort of came out in September, there was a very strong return from international equities, and it was quite benign in Australia. But to see those returns over the last 2 months, with those reports we're now sending out, it'll be quite a surprise, I think, or a pleasant surprise to most clients. If we now move on to international equities.
You mentioned, Sam, that international markets have been doing well all year, and that's absolutely right. And so when you look now at how developed markets have gone throughout the year, they've got an amazing 23.2% return, which is phenomenal. And that is driven a lot by the US. You can see there that the US is up by 25.7%. Now, that is due to the high tech stocks, those NASDAQ stocks. They're up 50% for the year. So that's really driven markets. But we should keep in mind that other markets have contributed to this strong return as well. You can see in the chart that both the European market and the Japanese market are both up by over 19%. And they're significant contributions to the global equity market. So it's really a sign of how important being diversified is, Sam, that you capture all markets around the world.
Yeah, it's certainly something that we harp on about quite a lot, but just that importance of diversification, having exposure both domestically and international to the stocks, because you don't know which market is going to perform when. And Australia is heavily dominated by mining and banks. So when they're on the nose, you really do need exposure to tech stocks like we've demonstrated in that slide just there.
That's right.
So Steve, what's happened in the emerging markets, which are primarily dominated by China? How have they performed over the last quarter and really over the last 12 months?
Yeah, Sam, in fact, if we took China out, the emerging markets would also have very similar returns to the developed markets. But China, as you said, is the biggest part of the emerging markets, and that is down a staggering 11.7%. Of markets around the world, that is certainly the biggest market that's got a big negative return in front of it. You know, Sam, this time last year, the analysts were saying that we're probably heading into a recession and it's really bad time to be in equities, but it will be a good time to be in Chinese stocks because they're coming out of the COVID lockdown. Well, they couldn't have got it more wrong. It's been a great year to be in equities generally and a really bad year to be in Chinese stocks. So you can see that the emerging markets have still done pretty well. They're up 9%, but of course they are being pulled down by that big negative return in the Chinese market.
Yes, and just to that point that you made earlier, just the noise that can be around towards the end of December and early January about forecasts. Like, as you said, that the forecast really was for the 12 months in January 2023. Doom and gloom, we're headed for a recession, interest rates are up, bonds will do extremely well. Emerging markets is not where you want to play, but ultimately that's not what's panned out. So Steve, now that the central banks in the US have sort of signaled the fact that this interest rate cycle is coming to an end and there's the potential, I say potential, cuts in the future, how has the bond market reacted for the last quarter and 12 months to end of December?
Well, over the 12 months, it wasn't a great looking picture, Sam. You can see in the chart here, we've got a quarter by quarter returns. Now, in the first quarter, you can see there is a positive return for bonds. That's because some of those US regional banks fell over, and there was a big fear that there'd be a contagion throughout the financial world and then potentially another GFC. So stocks fell, bonds went up. So bonds at least were performing their traditional role as being a defensive asset. But you can then see in the second quarter and the third quarter, as inflation kept on being persistent, yields kept going up as interest rates kept rising both in the US and Australia. And you see those two negative quarters. Once again, by the end of the third quarter, it was looking pretty gloomy for bondholders again, with a return of about zero. But then everything changed on the Fed pivot, and you can see, Sam, a drop in the yields there in the last 8 weeks. Those US yields have dropped by 100 bips. That's 1%. I know 1% sounds small, but in the bond world, it's huge.
Significant.
And you can see that the Australian bond market and the global bond market are both up by more than 5% for the year. That's a really strong return. Sam, those returns are stronger than what anyone would have got from an Australian term deposit that
Yes.
they bought at the start of the year. So bonds are definitely on the way back. They've still got some more work to do, but they're certainly now providing their traditional role of both providing income and being a defensive part of the portfolio.
Well, we might end it there. Thank you very much for attending this session, and we look forward to catching up with you next quarter.